day this morning for markets, certainly, and the entire week. A lot of economic data. We are awaiting the latest ADP national employment report. That's out at 8:15 a.m. on the East Coast. At 2 p.m. Eastern today, we'll also get the Federal Reserve's take on how the economy is recovering. We'll get the latest Beige Book report. I want to bring in Wells Fargo Senior Vice President of Wealth and Retirement, David Carroll, for more on this and the outlook for the new year. Good to see you, David.
Good to see you.
Thanks so much for joining us. So much happening in markets. Before we get to all this economic data, let me get your take on sort of what's going on behind the headlines. You've got redemptions in hedge funds, a lot of marquee hedge funds seeing losses for the month of November and for the year. You've got the commodity sector continuing to be under pressure and an economy that's real slow. Equities are up 2015, but nothing to write home about. How would you assess the situation today going into 2016?
We saw a marked shift in investor attitudes at the end of the second quarter of this year. Asset flows slowed down, retail trading activity slowed down, and at the time, I sort of attributed it to markets were topping out, valuations were companies were pretty fully valued. Then you had the pullback in August. And so we've seen liquidity build, and generally we've seen our investors become a little more tenuous heading into the next year.
How do you think about that in the context of the economic cycle? This is obviously not your first rodeo. We've seen 3 economic cycles roll over in the last 15 years. CEOs at the end of the second quarter said, look, profits have probably peaked. They've subsequently, in the Roundtable CEO Index yesterday, hit basically a 3-quarter low. Profits have been guided down. How do you tell people that that's okay and just to own stocks in the face of it?
Well, I think you have to look behind the numbers a little bit and pull energy out. Third quarter earnings actually were up about 6.5%, excluding energy on the S&P 500, which is not bad year over year. We feel like the outlook for next year is relatively positive, another 2.5%, maybe 3% GDP growth for the year. Equities are the only place that are going to be inflation adjusted for a return for clients, and we think long run, people should stay invested and not try to time the market.
Well, I mean, if we actually just fact check that a bit, the financials actually were down 8% earnings in the quarter. Industrials have negative earnings growth. It's not just energy. The forward-looking indicators, ISM yesterday was one of the worst numbers we've seen. It was signaling a recession, PMI below 50. Do any of these leading indicators change your mind on 2.5% to 3% GDP growth? And what if the market and bond yields are right, that we could actually be developing recessionary expectations here?
Well, as the adage goes, expansions don't die of old age. We still don't see anything on the horizon that would trigger a definitive pullback. So we are mildly bullish on the economy.
Well, economic cycles actually do die of old age. That's why they call them cycles.
Well,
it's time that's a factor.
But there's a different thing going on, because if you look at the data, there's 35 years where we go into a recession every 7 years or so, and you need about 300 basis points of stimulus from the Fed to keep the economy growing. So we're now at a inflection point where we can't get the 300 basis points of stimulus. So what do you think about that, David? What do you say to a client that walks in with, and they're a policy wonk, and they say to you, okay, what are we going to do now? We're getting a little longer in the tooth. We can debate about whether the expansion is going to end or not. I'm in your camp. I think Keith could be the global warming person here at the table as it relates to the economy. but what do you say?
We try to take a long-term view of these things and don't time the markets. We believe in broadly diversifying our clients' portfolios, which include exposure around the world. We all know what's happened with emerging markets in the last couple of years. We're mildly more positive on emerging markets, both equity and debt, than we were coming into the second half of this year.
You're not worried that the Fed has no bullets left in the chamber?
I am concerned about it, but I think we need a return to normalization. I think the real economy will yawn off this first rate increase.
And you think that happens in 2 weeks?
I think it does. I think the Fed has a real credibility.
They raise rates in 2 weeks?
I think they should. I mean, I want to see all the people how they behave with the first rate hike into a slowdown. You've never seen it because it's never happened. We've never raised rates with an ISM below 50. So I say have at it. Just get on with it. Let's see what happens.
I win a bet if they raise. So
last time we raised rates, there was no iPhone. Just remember that, okay? It's been a long time.
So any sectors that you think are going to be leading this bullish stance in 2016?
We've liked technology all year long. Consumer durables we like. And in general, we like Europe. We think there are great values for large cap industrials in Europe.
David, great to have you on the show today.
Thanks for having me.
Thank you so much. David Carroll from Wells Fargo there. We're